Have you ever reviewed your financial report and celebrated financial milestones? In January, you hit the $1 million mark for the first time in sales. The business is profitable and there's money in the bank. So you celebrate by paying your team year-end bonuses and buying a new truck. But by February, you actually need to borrow money from the line of credit to make payroll. And then the ultimate big surprise is in April when your tax accountant tells you that you owe more money than you actually have in the bank. When you're riding a financial roller coaster, it's tempting to blame your tax accountant. It's easy to lose trust in your financial reports, but please do not give up on either one of them. It's not the financial statements, it's actually the viewpoint. There are countless ways to view the financial information in your business. Stay tuned. In this video, I'm going to share the 7 most important financial viewpoints so you can stop riding that financial roller coaster. The problem that I find when I start working with clients is they have a report that has the title profit and loss statement, but it's really based on the tax return. And so the tax accountant took the information from the tax return and put it in a format that looks like a profit and loss statement, but it's really not. And so what ends up happening is you have this false sense of profitability because it does not include all of the cost of doing business, owner's pay or employee or the benefits, income taxes. Those might not be deductible for the IRS, but they are definitely cost of doing business. You need the cash flow for it, and it needs to be considered in your prices. It also makes it very difficult to compare to industry benchmarks because it looks like the business is performing well, but it's the reason why you're still struggling financially and you're finding it difficult to grow. This report reflects taxable income, not net profit. It's important for you to see a profit and loss statement that is based on true profitability of the business. How much different would your financial decisions be if you actually saw profit reported this way? So instead of on the left side seeing it based on the tax return, the $267,000 bottom line, what if you actually saw the cost of owner's compensation, that cash flow commitment, and also the cash flow commitment for the income taxes? Whether you pay quarterly or at the end of the year, it doesn't matter. It's coming. Because of the profitability and the tax structure that you've selected, the tax bill is coming. And so when you see this information in black and white in this format, it makes it a lot easier to make decisions and feel confident in those decisions. Taxes are important to consider when running a business, but taxes are only one part of the financial story. Do you remember using a viewfinder when you were younger? You inserted a disc in the top of the camera and you could flip through the images of animals at the zoo. Well, you need a viewfinder for your business too. There are countless ways to view financial information. Here are the 7 that I have found most helpful for operating a service company. The strategy helps you consider what the future might hold, and it helps you align your plan with your actual resources, so that way you can confirm that it's actually realistic. Your price is what you charge, and it's the only sustainable source of cash, so it's very important that you charge the right price. Cash is the oxygen for your business. It's natural to not think about it until you need more. Profit and cash are not the same. A simple cash flow statement is great for you to see where the money came from and how the balance changed from the previous period. Profit confirms that the business operated in a financially strong way. It reports net profit. Your tax is a viewpoint required to file tax returns and helps your company stay compliant with the tax authority. It reports taxable income, which is not the same as net profit or cash flow. Net worth is the viewpoint on your balance sheet. It provides a clear picture of what the company has to show for all of the hard work. Do you have more cash in the bank? Have you purchased more assets? Have you paid down your debt? It shows the company's overall financial health. Return is the owner's return on investment for the risk that they assumed when they invested in the business. Keep in mind the return on investment, profit, and owner's pay are not the same. Those are three very different numbers. You also should see a return on your investment, not only of the money, but also the time and the energy that are invested in the company. When you only focus on reducing your taxes, you'll wonder, where did the money go? Because your finances are out of balance. Now, keep in mind, tax is the area that screams at you and becomes a squeaky wheel if you ignore it too long. Because let's face it, if you're not filing your tax return and paying the tax on time, you'll eventually get letters in the mail, and you will also it could escalate to a visit from the IRS. But the good news is, there is also a power area that naturally drives the business forward. Did you know that your business only has three ways to generate money? Investments from the owners, loans from the bank, and sales from the customers. There's really only one that's sustainable long term. This is why the price that you charge your customers is so important. It's the one and only way to drive the company's ability to generate cash. When you think about the 7 financial viewpoints, consider the first 3 as foundational: the strategy, the price, and the cash. And your financial strategy determines the prices, and your prices drive cash flow. The remaining 4 financial viewpoints are simply reporting formats of how cash flows through the business. The costs that qualify as an expense show up on the profit and loss statement to calculate net income. The costs that are considered a tax deduction show up on the tax return to calculate taxable income. The costs that are considered to be an asset or a reduction of your loan payments, those show up on the balance sheet to calculate net worth of the company. And then also the costs that are considered a return on the owner's investment are used to calculate the ROI. So that way the owner can see what benefit they're receiving compared to the risk that they took. The next thing we need to consider is, why is the tax viewpoint so dangerous? First of all, let's look at who the reports are designed for. So the tax return is designed purely for the IRS based on the tax law, so you can calculate taxable income. It helps you stay compliant with the tax authorities. The profit and loss statement is designed for you to see true profitability. The goal is to match income and expenses in the right time period so profit is stabilized and tells the true story that is happening in your business. Another reason why it's dangerous to only look at the tax viewpoint is that it provides a very incomplete picture of your finances. I alluded to this a little bit earlier in one of the slides, and depending on your tax structure, you can see very different numbers. So if we look at true profitability, the net profit is $117,000. But depending on your tax structure, if you're a sole proprietor, LLC, or partnership, if you're relying on this number to be your profit, you're going to see $252,000. S corporations, $177,000, C corporations, $102,000. And so the tax treatment of depreciation expense, because what's on your books might be different than what you can actually claim on the tax return because of Section 179. You've got owner's pay and income taxes. All of those are reported differently dependent on your tax structure. And so keep in mind, whether the expenses are tax deductible or not is irrelevant when you're calculating net profit. All 3 numbers are a cost of doing business. They all affect cash flow, and they should be considered when you set your prices. So as you can see from this illustration, the profit and loss statement and the tax return are very different reports with very different purposes, calculating very different numbers. The bottom line is, roller coasters are a lot of fun when you are at an amusement park, but they are not fun when you are running a business. Financial surprises will continue to happen if the tax viewpoint is your primary source of information. You need a balanced approach. I recommend you start with learning how money flows through your company. When you actually master the cash piece of the puzzle, you'll be able to quickly see what's working and what's not. I also encourage you to flip to the right financial viewpoint before you make a decision. For example, if your tax accountant encourages you to buy a new asset before the end of the year, Consider how that purchase will affect your cash flow, profitability, and also your prices. Thank you so much for watching. As always, if you've got a business finance question, please reach out. I'm happy to point you in the right direction.